Welcome back to another video. In this video, we will be covering about futures, particularly. And in the last couple of videos, we discussed about fundamental analysis, we discussed about technical analysis, and how we can use these tools in order to analyze market and stocks in general. But in the coming videos, we'll be talking about derivatives in deep. So let's get started. Derivative markets in India dates back to 2000s, where BSC start in June 2000, BSC started its first derivative, where derivative contracts were traded into the market, where people could buy options, where people could buy different contracts, dating from Nifty to Bank Nifty, and the historical context in India dates back to 320 BCE, where Kautilya, who was economist, philosopher, and he published something called Arthashastra. So in Arthashastra, he discussed about a particular concept called forwards. So in order to understand futures, we need to look at forwards. So I will give you an example. Try to understand how exactly forwards used to work at that time. So in case of that time, imagine there is a paddy field, rice field, and in next month the rice crop is going to come. So the farmers who are anticipating that this time we will be growing this much rice, let's say 10 quintals of rice, and the market price of that rice at that time will be, let's say, 300 rupees a quintal. But Kautilya, what he did is that he bought the 200, the 300 rupees per quintal ka crop at a pre-decided rate from the farmers and told that I am going to give you 250 rupees right now for this thing that is going to harvest after 1 month. And that's how they came. So what happened in that particular situation? The farmer and the Kautilya. So the Kautilya was, advisor to the wealthy families. So they came in contract where the Kautilya will be giving 250 rupees per quintal to the farmer, and the farmer in exchange will be signing a written contract that whatever, for example, 10 quintals of crop that he's going to produce, he's going to give it away uh, to the wealthy families. So in this, what amount of money that the wealthy families made? So obviously, if after a month of harvest, the market price of the crop, let's say, was 350 rupees, so they made money around 100 rupees. So in this particular situation, Kautilya made a gain of 100 rupees. So that's how forward contracts in general works. There's a written agreement between the two parties to exchange something, and they cannot breach that particular contract. The prices are pre-decided, and the full amount of this particular contract is paid in cash. So that was about forwards, which dates back to 320 BCE. What is right now? It's called futures and options. Let me talk about futures. So future is the exact same thing, but understand that forward was not, why forward was not the best case scenario to go ahead with, because if the parties default, let's say the farmer is not able to produce that much amount of crop and give it to the Kautilya, then that full contract will be breached. Or for example, there's no particular exchange. So, there is illiquidity because the contract is exchanged between the two parties. So let's say the farmer wants to sell his crop to someone else, he won't be able to do it because there are no more buyers of these contracts. So because he wants, some kind of fertilizer to produce paddy, and he doesn't have the money and he wants to sell forwards of his crop, he won't be able to sell it. Same in the case of cotton. Let's say in that particular area, no one is willing to give the crop to Kautilya at a pre-decided rate. Then, because of this thing, there is a thing of illiquidity in the market. So, but in today's scenario, the futures are readily available. So, available in what sense? These are readily available in terms of contracts. These contracts are for the next 3 months and is renewed every month, so that a new contract of the, let's say, this month and a mid month and a far month. So every time this month gets expired, the next month the far month adds on. So henceforth it works. So every month on Thursday of the last Thursday of a month, a future contract expires. So a future contract can be of index, it can be of stocks. So what I'm trying to tell, I think, like I am sounding little bit complicated, but in the later sections we will understand whatever I'm trying to say. So let's talk about forwards. First, you understand what is forwards, because today also forward contracts works, but they are for big institutions, they are betting their money on something which has some value which is other than what is the real time value of the thing. For example, Citibank is having, let's say, 10 million shares of Asian Paints, and they are telling JP Morgan to buy this particular thing, anticipating that the price of Asian Paints, whatever shares they are holding, is going to go down. That's why they're selling it, right? And JP Morgan thinks that the price of Asian Paints at today's market price is cheaper, and that the price of the Asian Paints is going to go up. So these guys will be going into a contract called forwards contract. But in today's scenario, as I was talking about the illiquidity, it is not very common to see forward contracts, and most of the contracts are over the counter. That means, like, no one in the public most probably know about it, and these contracts are done by huge parties, and so that there's no use of understanding all of this. But to understand the concept of how future works, it is similar to forwards, but in case of futures, it is highly regulated, and these are regulated by SEBI, and it is easily exchanged on indexes like NSE and BSE, where you can easily trade into those instruments. So let me go back to the forward contract example. Let's say the price of gold increases, the price of gold decreases, and the price of gold remains the same. What will be the case in case of forward if I exchange some kind of forward contract with another party? Uh, let's say today the price of gold is around 70,000 rupees per 10 grams. And I came into a contract with a person stating that I want to buy gold, which I'm expecting that it will rise to 75,000 rupees in the next coming month. So I want to buy this 75,000 future contract at a price of 7,500 rupees. So how am I exactly able to do that? It's because I am taking a leverage on this particular contract. So what exactly is leverage? I'm not physically buying that 10 grams of gold right now. I will be able to buy it at a future price of 75,000. But in order to exchange this particular contract, and you if for example the price of gold rises to 72,000 rupees, or from 70,000 to 72,000, so my contract price will go from 7,000 to 7,200 rupees. I will just exchange that contract, instead of buying physical gold of 70,000 rupees of worth and then exchanging it to 72,000 rupees, because the contract is going to expire next month. Obviously, I can sell that particular contract at any point of time, but the true sense behind coming into futures is the very reason that the asset itself has more value. And if I try to manipulate or buy, or make a profit from buying and exchanging this particular asset, it will take a lot more amount of money. But in case of futures, you need, let's say, 20% of the margin in order to contract the same thing. And if you make a financial gain out of that particular thing, if it goes into your direction, you make profit. If it doesn't go into your direction, you make a loss. So there is unlimited chance of you making profit and losses at the same time. So this is about future contract. Because let's say a stock who's having 100 rupees of 100 rupees of share price, and you buy a future contract on that particular stock. Let's say the and on a 20%, giving a 20% margin. So what is the leverage amount? I'm getting 5x the leverage amount. So for example, for 100 rupees share, I am imagine 100. The contract size is 100. So 100 into 100, that is 10,000 rupees of the asset I am able to trade at what price I'm able to trade this particular full contract size, total contract size 10,000 rupees on from 1,000 rupees. So I require, let's say, 2,000 rupees. So I require a margin of 2,000 rupees in order to trade 10,000 rupees of shares. So if the price of share goes to from 100 to 110, I make a 10% profit on my future contract. That I bought it at how much price? 2000 price. The same contract price goes to 2200. So there's not actually an asset. So if you are able to understand this in a single frame, I'm not buying a particular piece of asset in this case. I am trying to, bet the market. I'm trying to predict. There's my some kind of intuition that the price of a particular asset will go up and down, and in order to get more gain out of this particular, scenario, I can draw a futures contract. I can just go ahead and buy a futures contract and make money out of it. Same goes with options. In options, the option buyer pays the premium, the option seller takes the premium. Let me tell you everything in detail. So in case of this, if I bought a particular contract and a price, for example 70,000 was the gold, 70,000 was the current gold price. I bought a future contract, thinking that the gold, and I bought a future contract thinking that the gold will go from 70,000 to 75,000. In first scenario, if the price of gold increases, my my future price, my future contract worth will increase, and hence I'll be able to make money. What if the price go from 70,000 to 65,000? I will be incurring a loss of some rupees. Let's say, I bought the same contract for 7,000 rupees. What will be my leverage? My leverage is 10x. 70,000 rupees ka gold, I'm able to trade at 7,000 rupees. Just I'm, transacting the contracts. It is a written piece of paper that I'm buying the gold at 70,000 rupees. And if the price increases, I'll make money. If the price decreases, I'll lose the money. So the 7,000 is what I'm just basically trying to uh, trade. So 70,000 it goes to 75,000. I make 7,500 rupees. I make 500 rupees. 70,000 goes to 65,000. My contract price went from 7,000 to 6,500. I make loss. In the second scenario, if my direction goes wrong, I make a loss. In the scenario where the price of gold remains the same, I don't incur any profits or losses. My price of futures remains the same, and I don't incur any type of charges. So this is about forwards. Let's tell about settlement in forward contracts. So in those particular time, there was physical settlement. I told you about the Kautilya thing, where the farmer actually needs to, you know, uh, give the rice, the quintal, the 10-20 quintals of rice to the Kautilya. And in case of gold, actually, the person coming into the contract, and if that particular contract goes, up or down, at the end of the day, they have to physically settle the gold because they decided the price of these contracts, you know, before before the actual settlement period arrives. So in case of forward contracts, the things or the materials need to be physically settled, and a payment of price, and whatever is the difference between whatever amount of future earning or losses I made, I have to settle it, whatever the current price of gold changes. So what are the risks? There's liquidity risk and there's default risk. What if Kautilya doesn't pay or the farmers doesn't pay, doesn't give the rice? There's a regulatory risk. So there's no one, and there's no government, there's no regulatory party, there's no law enforcement which is behind this particular contract and which states that this is very true. And if any of the party defaults, that the law enforcement actually will act upon it and will try to take the money out from the pocket who has been deregulating the system. So there's no regulatory any type of authority in this forward contract. But in case of regulated markets, like Indian market, Indian stock market, or let's say Dow or DAX or Nikkei, or Shanghai, any type of exchanges, these are very well regulated because there is statutory body who is taking full control of whatever things are happening in the exchange. So in case of futures, options, or stocks, any type of these things related to investing, financing, trading, these are highly regulated in India. And rigidity in contract terms. So like these contracts were pre-decided, and these contracts were not changing the price as the price of the instrument is going up and down. But in case of a future contract, the everything is real time. If the price of asset moves, my contract price will move with it. So there's no rigidity. So there's no rigidity in case of forward contracts. It's designed to mitigate forward contracts risk. It's about future contract, and it's standardized, and it's transparent, and they're highly liquid. So they are legally binding agreement if you are coming into a future contract, and if it is in the money, and if you don't actually, draw your rights at the end of the expiry, you need to physically settle those particular number of shares. Either you have to buy those shares or you have to give away those shares if you don't actually exercise your right on before the expiry date. That is about physical settlement of future contract, and they are very standardized. They have fixed number of lots. It depends on actually stocks to stocks and index to index, but the quality, the quantity, the delivery, everything is standardized. So there's a particular science behind of all of this. It's not randomly, and it's not in the case of farmers, or not in the case of gold, where nothing is, where how many grams of gold I'm going to trade. It can vary upon me, or the amount of quintals that I produced rice. It doesn't depend like that. It actually is very standardized, and the daily settlements of gains and losses. So whatever money you made on future contracts, or the money you have lost on future contract, will be settled on an M2M basis. What is M2M basis? It is mark to mark basis. For example, you earn 10,000 rupees on a future contract of Tata Steel. The 10,000 rupees, the gain will be settled daily, and it will be showing in the profit will be showing into your demat account at the end of the day. And if you incur loss of, let's say, 15,000 rupees, so it will be deducted from your funds the day itself. But in case of options, when you are doing BTST, buy today sell tomorrow kind of options, the options are not mark to market. They don't settle on mark to market basis. They settle only when there is when some party exit the particular contract, or when you do it on the day of expiry, when it settles on the day of expiry. So it doesn't depend on mark to market basis. So what you should learn about before your first futures trade: you should understand the contract specifications and the margin requirements. So in case of futures, the margin requirements is much higher compared to options and compared to stocks. So let's say one stock, Tata Steel, which you're trying to buy at 500 rupees, but if you want to buy a future contract stating that okay, the price of Tata Steel is going to go from 500 to 700 rupees, you cannot buy one single quantity of future contract. In case of Tata Steel, you have to buy a specific number of quantities of share. Let's say 1,000 shares of Tata Steel at a price of 500. That the total contract price in that case will be how much? 5 lakh rupees, and you have to pay a certain margin. So you don't need to pay full full total contract size in order to make a futures trade. You have to pay a particular margin, let's say 20%. So 5 lakhs ka 20% will be somewhere around 1 lakh rupees. So you will be able to trade 100 shares of Tata Steel at 1 lakh rupees instead of 5 lakh rupees, and you can make the actual gain from that only 1 lakh rupees of margin. So from 500, the share moves to 550. So, and you bought 100 quantities, that's just one future contract. So, how much gain you made? You made 5,000 rupees of gain. The extra 50 multiplied by 100 quantity gives you a total of 5,000 rupees. So, on a contract of 1 lakh rupees, you made a profit of 5% on a single day. That's how it works. So you have to analyze your market conditions and manage your risk. If you know that how exactly to use these future contracts, it can be super helpful in your investing and trading career, because you will be able to get a lot more leverage from this future contract. And as it is settled on M2M basis, you can actually make a decent amount of money exiting this contracts on the same day and taking this lump sum at your home. So, and you need to have a defined trading objectives and exit strategies. So, example, you have made your full analysis based on the indicators, based on the candlestick chart patterns, and you know where is the entry, where is the exit. Now you got into futures contract of the same. What are the three options that are available? There are four options actually. If you think that a particular stock is going to go up, there are four options where you can make money if that stock is registered under FNO segment. What is FNO segment? If that stock is highly liquid and the exchange allows you to go into futures and options from on that particular trade on that particular stock. So there are oddly 200 stocks which are available in order to do uh, futures and options trading in India, and they keeps on changing according to the regulatory authorities of India. So SEBI decides which are the stocks that should be traded in futures and options, and which are the stocks that should not be traded in futures and options. So in case of Tata Steel, let's say it is an FNO stock, you can go easily take a trade. If you think that okay, it's going to go up, you can buy it in cash segment. Like for that means you can just go ahead and give 500 rupees and buy one share, or hold it for some time until unless you make a profit of decent money and whatever you thought was the target. Another, if you think that the move is going to come on a single day, that on the day you bought the contract, so in that case you can just go ahead and do intraday. So instead of one stock for 500, you can actually buy five stocks for 500, because there is how much 5x leverage that is given on intraday basis, but you have to exit the trade on the day itself. Sorry. Next option I have is I can just go ahead and do options on this particular Tata Steel. So I can just draw a 500C option and exercise my right, and I can make money in a single day, or I can hold it and I can buy monthly option of this month or next month, mid month, or the after month. I have three contracts and I can go ahead and buy any kind of option contract for this stock. Last option, I can go ahead and buy futures in case of Tata Steel, and I can draw a future contract of let's say 500 CE of July. Oh, sorry, 500 July. I can go ahead and buy Tata Steel futures July, and I can go ahead and buy let's say how many lots. It is pre-decided in the future contract, and you can make money holding it if you have a particular view at your trade, or you can just exit it on the same day itself. You can hold it to the I told you the last Thursday of a month, that is the expiry of that contract. And what if you want to hold it more? You can just exit a contract on the last Thursday, before the last Thursday of a particular month, and you can buy the next month's contract instead of today's month, in order to continue that particular position. That's how in futures you can trade. And you should have a particular trading strategy at your hand, what exactly you have to do in order to make financial gain out of a situation. So there's pre-trade, and there's trade execution, and there's post-trade. So in the pre-trade segment of how the future trade, like let's bifurcate it in a process. So first you need to do your market analysis, and you should have some kind of strategy at your hand. We will be teaching you some strategy, how exactly to go for future trades and what to look exactly into the trades. Next comes trade execution. It's very easy to get into future trades nowadays. Nowadays, with the advent of technology, maybe it was not available at that time of Kautilya, but today it's very easy. You can just go ahead and buy like a stock. You should just have that much margin into your demat account, and you will be good to go. And next is the settlement and risk management. So every day the future contract will be settling on an M to M basis. So at the end of the day, you should have that much margin where it can easily take profits, it can just book profits and take losses if any on that particular, if arrives on that particular day. So let's say three scenarios of post agreement. So there is favorable market movement, there's unfavorable market movement, there's no market movement. So in case of favorable market movement, if your particular future contract, if you bought a particular future contract and the future contracts are actually the particular underlying asset, be it index or the stock goes up, you will be realizing profit. This is called favorable market movement. The movement was in your favor. If it is unfavorable market movement, that particular asset class went down. You bought a futures contract, and that particular asset class went down on that day or the coming days. So it is unfavorable market movement, and you will be incurring some kind of losses for that future contract. And in no market movement at all, the future contract will not be changing any kind of price, and you won't be charged for any profits or losses. Next, in the section 3, we'll be looking at leverage. So what I was trying to justify till now, what exactly is leverage? And so leverage and payoff. So what is leverage? Leverage amplifies both gains and losses. So it is actually a double-edged sword. So either it can make you super, super rich, or it can make you very poor. Why am I saying this? Because leverage is it gives you an opportunity to to trade in more number of quantities. So in case of Tata Steel, let's say I was having this 500 rupees. I would have bought one share, but now in case of intraday basis, I have now five shares. Now I can just go ahead and buy five intraday shares of this Tata Motors in just 500 rupees. But what if the share price comes down from 500 rupees to, let's say, 450 rupees? I will be incurring actually a lot more losses. So in this case, I had 5x leverage. So my losses will be 5x. So now, if I would have bought this on a cash basis, I would have made a loss of how much, how many rupees? 50 rupees. But that I bought, now that I bought the shares on intraday basis, this loss will be multiplied with 5x. So 50 into 5 will be 250 rupees will be my loss if the stock falls from 500 to 450. So in the example that we saw, you would have actually made a loss of 50% on your capital just because you took 5x leverage. Actually, all these leverage instruments are very risky, but at the same times they can make a lot more money, and actually you can gain a lot of money. The price of contracts sometimes goes from 10 rupees to unlimited, because the downside is very particular. You should have a view that, like I was discussing with my friend, that what is the probability of you making money if you bought a put or a call. So what I'm trying to say is that if I am short on something, that this thing is going to go down, and if I'm long on something and this thing is going to go up, in which scenario I can make more money. He was telling me this particular logic. The downside is only minus 100%. Let's say 1500 rupees. Let's say this pen. This pen is for how much rupee? How many rupees? Let's say 20 rupees. The downside of this pen in this case, if the people are dying for this pen is super super useful, and if I write something from this, actually it will happen. It will. This is a magic pen. So the downside, if no one buys this, no one buys it, and if people are trading this pen, it can, how much it can go down? It can go down to zero. From 20 to zero, how many percentage down it is? 100%. But let's say if this pen is in high demand, how much it can go? It can go to, 40, 400, 4 lakh, 4 crores. So there is unlimited upside to it. Same goes with leveraged instruments as well. Why people are dying of doing, futures and options nowadays? Why India is becoming the biggest derivative market? Because these leverage instruments allow people to earn a lot of money, and people are exposed to this idea that they can make a lot of money. But if you understand the risk behind it, if you have a right mindset, if you have a right particular strategy, which is giving you fairly very less losses and giving you a hefty profits. You can use these leveraged instruments in order to make more money. Because if I have, let's say, 1,000 rupees, I will be able to make only 100 rupees when the Tata Motors goes to 500 to 50, 550 rupees. So on 1,000 rupees of capital, if you understand my viewpoint, I am able to make a gain if the Tata Motors, goes from Tata Steel goes to, 10% up today. I'll be able to make only 10% of my, like, I'll be able to make 100 rupees on 1,000 rupees of investment. But if I use a leveraged instrument instead, I would have bought how many shares? I would have bought 10 shares of Tata Motors for 1,000 rupees. I would have bought 10 shares of Tata Motors, and that these 10 shares together with 5x leverage on 10%, 10% return would have yielded me 500 rupees. That's a 50% ROI. From 10% ROI to 50% ROI, if you have the right mindset, strategy, and the trade went into your favorable direction instead of neutral and unfavorable direction. So that is about leverage instrument and how it gives payoff. So use it very wisely. It can very much maximize your return. Everyone uses it, and you should learn how to use it, even though you're not using it now. But at some point of time in future, you should definitely use it in order to make, in order to make huge financial gains. And there should be a balance between the risk and reward. Everything comes at a cost, but the cost should be well versed of, and we should be very much aware of the uh, downside. As Rakesh Jhunjhunwala once said, that it is okay to make a mistake, but that mistake should not be that much huge that you cannot live up to make another mistake. He made a loss of 250 crore rupees on a single trade, but he didn't put all his capital into that single trade. He had more money, so he was, he afforded, and he was happily telling that he, I lost this much money, but I learned something, and at the end of the day, I have more money to make investments, to make trades. I have more money to make more mistakes. So that is about risk management. You should not put, even your, 10% of your capital or 20%, more than 20% of your capital in a single trade. If you have, let's say, 10,000 rupees, you should, try to make a trade of 2,000 rupees, 3,000 rupees at max. Because if you lose these 2,000, 3,000 rupees, you will be able to make more number of trades. Let's say more four trades from 2,000, 2,000, 2,000, 2,000. But if you lost all the 10,000 rupees worth of money on a single trade, thinking that the markets will go either up or either go down, actually your position will be in huge losses. So how do we calculate leverage? So it is about the total value of position. In case of us was like the 500 rupees, and what is the margin requirement in intraday? We require a margin of 100 rupees. So what is the leverage we have taken? It is 5x leverage. So 5 is the leverage in case of my position. And same goes for futures. You requires 20% margin. So 10 lakh rupees of shares, one future contract, you will be able to get it in 2 lakh rupees. And that again is split into margin and span, and we'll talk it about in later section. So it's important for managing risk. You can use futures as hedging your positions as well. So let's say you bought some 10,000 shares or 20,000 shares of a particular company, and that company is in F&O segment, so it is registered in futures and option segment. You can actually sell future contracts if in case of uncertainty like a budget, or any kind of GDP rate, interest rate, inflation, any type of data coming, big economic news that is circulated in the market, or some kind of war like event where you think that the markets, there is a huge possibility that the markets can go down. You can just you can calculate on the number of the amount of money that you put into shares. You can hedge this particular position with the future sell, and for that particular moment you will be able to make gains the amount of money that you are going to lose in your long-term position, you will be able to make money from the selling from the future sell position without incurring any amount of losses. So if the stocks goes up, you make money on stocks, but you lose in futures. But that is totally fine because it is about managing your risk. At the end of the day, you won't be losing any amount more than 1 or 2 percentage. But if you just go ahead and do naked position even in long term or in futures alone, you won't be able to manage it and make it a very calculated trade. You will be only sitting on a naked position which can actually make huge losses or huge profits. Everything. So understanding leverage ratio helps in decision making. So I will tell you about the future payoffs. So in long futures, so when I'm buying a future contract, actually, you'll see this graph. So this graph is of steps. So you can see, a particular linear graph curve. Why is it linear? Because the price of future contracts will be moving upward in a linear position or moving downwards in a linear position. Let's say my stock is moving like 111 percentage. So my long future position will be moving upward in the similar sense. But and if I lost money from let's say my position of Tata Motors was like 1,000 rupees per share it is, and I bought July futures of Tata Motors July Motors, and the stock went from 1,000 to 100. I made a linear profit of what 10 percentage. It's moved to 1,200. Again, I made a linear profit of how much? 20% from my initial capital. Same goes in the downward direction as well. From 1,000 rupees, the stock went to 950. The I made loss of how many percentage? 5 percentage. From 1,000, it went to 900. I made a loss from my initial capital of 10%. How much money that I put it into the futures. So the short position payoff curve is exactly the opposite. And let me show you with the help of an example. And it is M2M basis. I told you every day you will be, incurring some profits or losses if you are holding a futures position, so forth and so on. What is the important of margins? So why exactly margins are needed when you are doing a futures trading, and why platforms, why the broker houses in India, they charge you more than what is required in the span. So what I'm trying to say, it ensures that the traders, because at the end of the day, it's about the physical delivery of a particular instrument. So they don't want their position to be into risk, so they charge some kind of cushion, the amount of money that if the market is pretty much volatile, so they don't have to charge extra, or they don't have to make your accounts negative in a negative position, negative 10,000, negative 20,000, 30,000. At the end of the day, they are charging upfront margin, so that if any type of volatility comes and your trade actually goes into a negative position, they will be able to you will be able to bear that trade. And if you don't have enough initial margin, you won't be able to open a position, you won't be able to make a trade. That is the thing. And there should be a minimum balance other than the amount of margin that you're putting into the trade, that should be sitting into your demat account, because at the end of the day, if you incur any kind of losses, they have to be settled on an M2M basis. So for example, you're making 1.8 lakh rupees of futures trade. Just one futures trade you did of rupees 1.8 lakh. You should be having a capital of, I guess, 2.5 lakhs or 2.3 lakhs at least, because like 50,000 should be the extra money that should be, kept in order to mitigate any kind of gains or losses that the future contract is making on a daily basis. So you need to have an extra margin with yourself. So daily adjustments of account to reflect gains and losses. It prevents accumulation of excessive loss. So if you incur a loss of like 50,000, if you're getting charged every day, the losses will be deducted on an everyday basis. Instead of straight away taking your 50,000 on a one single day, you'll be taking 10,000 rupees, because if the position is going into losses. And obviously, if you think that the trade is not worth it and you have chosen the wrong direction, you can actually exit it at any particular point of time. So you don't have to wait until and unless your stop loss or take profit is achieved. You can actually exit it at any point of time. So it is important for maintaining liquidity in the market. So margins, the bigger perspective, margins vary across from different exchanges and instruments. Higher volatility instruments obviously requires higher margins because I told you margin is a cushion for brokers as well as for us in order to mitigate the risk of any huge losses that the brokers charge a higher margin in more volatile instruments and less margins in case of less volatile instrument, and balancing act between margin requirement and trading strategies is very important. So you need to form a trading strategy in such a way that you can actually lessen your margin requirements. If you buy a future position of this month and sell a future position of the next month, your overall margin will be like 20 to 30,000 rupees, because at the end of the day your risk is mitigated from the selling and the buying position on the same kind of instrument. So it is critical for a sustainable trading practice. What is the concept of margin call? So it is triggered when account balance falls below maintenance margin. So, yeah, actually the broker has all these powers. If you shortfall of margin at any particular point of time, they can cut short your trade if you don't have enough balance at your hand. Failure to meet a margin call may lead to a position liquidation. So you won't be able to, you won't be able to hold your position, and you will be getting some kind of call from the broker that if you don't deposit this much amount of money into your demand account, we are going to liquidate your position. So it is important to understand the risk management part of futures. Actually, before concluding this particular session, I would like to show you how exactly margins in India. What is the margin requirement for the trades. Let me go on Demat account and I'll show you how exactly it works. Let's say the Reliance share price is somewhere around 2,984. These days banks have been falling a lot, so I'll try to take HDFC Bank future contract. So the HDFC Bank share price is somewhere around 1,616. So we'll try to take HDFC Bank Foot refers for futures. So this July future is going to expire actually today, so we won't be able to buy it. But let's say I want to buy the next month ka futures contract. So how much margin it is taking, you can just see here. It is taking a margin of around 1,65,000, and the quantities for this particular trade is fixed. So you want the future contract. Let me just make it this. Yeah. I don't want it on an intraday basis. I want it on a delivery basis. So you see that the margin requirements it'll be the same. And you can set your limit price or the market price. You can just go ahead and click on market price and enter that into a particular contract, or you can limit your price at the particular share. So what this trade means is that I will be requiring 1,65,000 rupees in order to trade 550 quantities of HDFC Bank. So if I have a perspective in my mind that the 1629 rupees of share is going to go, let's say tomorrow, it actually moved how many points up? 12 rupees up today. Let's assume that tomorrow also it's going to go up 12 rupees. So how much amount of money that I'm going to make in a trade? I'll tell you. So 12,000, 12 into 550, the number of quantities. 12 into 550 is the amount of money that I'm going to. So 6,600 will be the amount of money that I'll be making on this trade tomorrow, and I can just as simple as it is to buy this future contract. This is where the selling also of this future contract is is very simple. You can just go ahead and on your portfolio and exit this particular position. So what you need to look at it, okay, if you would have bought 550 shares of HDFC Bank at 621,629 rupees, what would be? So Now you understand the now you understood the logic. If the HDFC Bank moves shares moves up from 1629 to, let's say, another 12 rupees up, what will be the price of it? That will be like 41, right? 1641. So I will be making a profit of 6,600 rupees. So why cannot I just make it on cash basis? Like, why cannot I just, buy all those 550 shares and hold it for another day? Let's see the margin requirement for the same. So in order to buy 550 shares of HDFC Bank, how much money do you require? So 1629 is the current price and 550 rupees. So you actually require 9 lakh rupees. No, 8 lakhs 95,000 rupees in order to buy 550 shares of HDFC Bank. But same 550 shares, and actually it moved, let's say, 12 rupees up tomorrow, so you will be making a profit of around 6,600 rupees. But future trading allows you to make how many to just give how much rupees, to give 1,65,000 rupees for 550 shares and make the same amount of profit. So you understood. So how much is my leverage now? So my leverage is around 5x. You understood. It's around 20% of my margin. 1,65,000 into 5. If I want to do the calculation, 165 into 5 will be around 8,25,000. So actually, I can draw five future contract. I can buy how many? 2,500 shares from future contract on the same 9 lakh rupees of capital, instead of buying, just 550 shares. That is the power of future contract. If you have the right kind of perspective, if you have the right kind of strategy. Today is what, 25th July. I am anticipating that tomorrow the markets can go up more, and the HDFC Bank will be able to make profits. Will be in upward position, because I think from past many years it has been falling very sharply, and it is into a particular range. And that's my perspective. Obviously, I can be wrong. And if the 629 went to 1600, the I will incur 30 rupees loss on 550 shares. So 30 rupees on 550 shares will be how much? 15,000 rupees. But that is, and it went sharply 30 rupees down. If it makes 10 rupees down movement, I will make 5,500 ka loss on, and it will be settled on my everyday basis. So my margin is, let's say, 8,000 rupees, and I have already made this trade, and I have this much margin left at my hand. So tomorrow, if I make, say, 6,000 rupees profit, at the end of the day, I will be able to see 14,000 rupees, 6,000 plus. If I make 5,000 rupees loss, my 5,000 will be deducted from my demat account. So that is about futures trading. I hope I was very clear about the concepts. There are a lot of futures and options stocks, and you can just go ahead and buy, sell all those things. You need to understand this concept in order to understand the big how the big management firms are able to hedge their positions with the help of futures trading. And you can just sell future contracts if you are buying lot many shares of something. So in an event where there is uncertainty, you can actually use this particular futures in order for you to make less losses. So I hope to see you in the next lecture. And in this full video, I covered about futures and how it can be used in order to make financial gains. And honestly, using futures is a very good thing, but you need to have that kind of mindset, because in this futures trading, you're not losing any kind of theta decay. What is theta decay? There's no kind of time ka movement that is pushing the price of the premium down. There's no premium charge. Whatever the price is upfront. So the HDFC Bank share is around 16 rupees, 1616 rupees, and the next month future contract you are getting it at 1629. So obviously the future contract is like kind of 1% up. So you can just think from the futures contract, okay, maybe the futures is trading at a premium. The price of the spot can move up. If the futures of a particular thing is going down, if the price of futures is down and it is negative, let's say 1%. So the spot price, and there's a difference between spot and futures in all the instruments, including Nifty. So there's spot. Whatever you can see here is Nifty spot 24,406. And for futures, the Nifty 50 ka price, let's see if it is in premium or it is into discount. So this is trading view. I'll just go ahead with identifying what is the Nifty futures. I think already, yeah, this with the exclamatory sign. The Nifty futures also are in the same kind of situation, but you can see the Nifty is actually negative, but it's slightly positive. It's not that positive. So there's no difference between the spot and the futures. Let's see in the case of HDFC Bank, what is the scenario in case of futures? HDFC. So I'll just go to futures. So these futures, like is for future trading, I think you'll and future is actually up by you can see the price of futures. So 1629. Even if the HDFC Bank is trading at 1616 rupees, 1616 rupees, but sorry, the futures of HDFC Bank is 1629. So the price that you have to pay for the future contract is coming at a premium. So that means the spot is going to go up. So let's see if the HDFC Bank goes up in more days, because obviously I'm also doing analysis just on the basis of my intuition. But for this lecture, this is all from my side. And thank you so much for watching. And if you like these videos, then please go ahead and watch the previous videos as well as the videos that will be coming forward. They'll be coming in the future. Okay. Thank you for watching and stay tuned for more such videos.